Investors are often told that moments of urgency create opportunity, but in financial markets, urgency more often creates mistakes. Right now, a growing number of voices are insisting that silver is on the verge of a historic breakout and that investors must act immediately before prices surge dramatically. The argument sounds compelling. Silver is described as undervalued, scarce, industrially essential, and historically resilient. It is framed as a hedge against inflation, currency debasement, geopolitical uncertainty, and financial instability all at once. In theory, that combination appears almost unbeatable. Yet, disciplined investors know that when an asset is presented as simultaneously safe, scarce, essential, manipulated lower, and about to explode higher, the narrative itself deserves closer examination, not automatic acceptance. The first claim often repeated is that silver remains deeply undervalued relative to its historical role as a store of wealth. But the assumption that historical status guarantees future price appreciation ignores how modern markets actually function. Unlike past centuries, silver today competes not only with gold, but with bonds, equities, real estate, and increasingly digital assets for capital allocation. Capital does not flow into assets because of historical significance alone. It flows toward assets that deliver liquidity, predictability, and institutional confidence. And this is where silver faces a structural challenge. While gold remains a recognized reserve asset held by central banks worldwide, silver does not occupy the same monetary position in modern financial systems. Central banks accumulate gold strategically. They do not accumulate silver. That difference alone should caution investors against assuming that silver automatically benefits from the same macroeconomic tailwinds as gold. Another frequently repeated argument is that industrial demand guarantees higher silver prices. It is true that silver plays an important role in electronics, solar technology, and medical equipment. However, industrial demand does not automatically translate into explosive price appreciation. In fact, industrial metals often experience price stability rather than price acceleration because manufacturers continuously adapt through substitution, efficiency improvements, and recycling technologies whenever costs begin rising too quickly. Markets are dynamic systems. When demand increases, supply responses follow, not always immediately, but eventually. This leads to another critical issue often overlooked in bullish silver narratives. Mining economics are not static. Rising prices incentivize exploration, investment, and production expansion. What appears to be scarcity today can become surplus tomorrow once capital flows into extraction. History has repeatedly demonstrated this cycle across commodities markets from copper to lithium to uranium. Silver is not immune to the same mechanism. Supporters of the immediate breakout thesis also point to inflation as a major catalyst. The logic sounds intuitive. Inflation erodes purchasing power, therefore hard assets like silver must rise. But real-world market behavior is more complicated. During several inflationary periods in recent decades, silver did not consistently outperform other assets. In some cases, equities and energy commodities delivered significantly stronger returns. Inflation alone does not guarantee silver appreciation. Timing, liquidity conditions, and monetary policy responses matter far more. Another pillar supporting the bullish narrative is the claim that silver is being artificially suppressed by large institutions through paper markets and derivatives. According to this argument, futures contracts create the illusion of abundance and distort real supply-demand dynamics. While leverage and derivatives certainly influence short-term price behavior, the assumption that suppression alone explains silver's valuation oversimplifies a complex global market structure. Institutional participation does not automatically imply manipulation. More often, it reflects hedging activity, liquidity provision, and macro positioning across multiple asset classes simultaneously. Perhaps the most important issue investors should consider is psychological framing. When markets are described as offering a rare window that requires immediate action, the message shifts from analysis to persuasion. And persuasion is not the same as evidence. Experienced investors recognize that genuine long-term opportunities rarely depend on urgency. They depend on fundamentals, capital flows, and macroeconomic alignment over time. Silver may indeed have a role in a diversified portfolio, but treating it as an inevitable breakout asset simply because it appears historically undervalued risks confusing narrative strength with market certainty. Understanding that distinction is the first step toward making rational investment decisions rather than emotional ones. One of the strongest claims supporting the idea that silver is dramatically undervalued today is the belief that large institutions are actively suppressing its price through paper markets and derivatives. According to this argument, futures contracts create the illusion of excess supply and prevent silver from reflecting its true intrinsic value. At first glance, this explanation sounds persuasive, but when examined carefully, it raises an important question. If manipulation alone determined long-term prices, why has silver remained volatile rather than permanently suppressed? Financial markets are complex ecosystems involving hedgers, producers, industrial users, speculative capital, and macro funds operating simultaneously. Futures contracts are not designed primarily to distort price discovery. They exist to transfer risk between participants. Mining companies hedge future production. Manufacturers hedge input costs. Institutional traders hedge portfolio exposure. In other words, derivatives are part of how markets function, not evidence that markets are being controlled. Another popular argument suggests that paper silver dramatically exceeds physical silver, implying that price discovery is disconnected from reality. Yet this interpretation misunderstands how leverage works across all major commodity markets. Oil, copper, and wheat futures also trade in volumes far exceeding physical supply. This is not a flaw in the system. It is a feature that allows liquidity to exist. Liquidity stabilizes markets more often than it distorts them. Claims of suppression also assume that institutions consistently act in one direction over long periods of time. But institutional positioning changes continuously in response to interest rates, currency strength, and global capital flows. Markets dominated by active hedging behavior rarely remain artificially mispriced for decades. Eventually, capital corrects distortions where they truly exist. Another cornerstone of the bullish silver narrative is the idea that global supply shortages are building beneath the surface and will soon trigger a dramatic price adjustment. This argument points to declining ore grades, rising extraction costs, and increasing industrial demand from renewable energy technologies. While these trends are real, the conclusion drawn from them is often exaggerated. Commodity markets do not respond to shortages in a straight line. Instead, they respond through substitution, recycling expansion, technological efficiency improvements, and delayed production investment cycles. When prices begin rising meaningfully, new supply enters the system faster than most investors expect. History has shown repeatedly that perceived scarcity in commodities often turns out to be temporary rather than structural. Perhaps the most widely repeated indicator used to support the silver breakout thesis is the gold-to-silver ratio. Supporters argue that because silver historically traded at a tighter ratio relative to gold, the current gap proves that silver must eventually surge higher to restore balance. But this interpretation assumes that historical ratios remain economically relevant in modern financial systems. They do not. Gold and silver served similar monetary roles centuries ago. Today, they serve very different functions. Gold operates primarily as a macro reserve asset and monetary hedge. Silver behaves more like a hybrid industrial commodity with partial monetary characteristics. Expecting the ratio to return to historical averages ignores how the structure of global finance has evolved. Markets change. Ratios change with them. Another overlooked reality is that investor attention itself influences price behavior. Assets that attract strong institutional participation tend to move earlier and more consistently during macroeconomic transitions. Silver, by contrast, often moves later in the cycle after gold has already established direction. This makes silver reactive rather than leading. The distinction matters. Investors who interpret delayed movement as suppressed opportunity may actually be observing normal market sequencing rather than artificial price control. Silver frequently follows liquidity shifts rather than initiating them. Understanding this timing dynamic helps explain why silver can remain cheap for extended periods without immediately correcting higher. Narratives built around manipulation, scarcity, and historical ratios create a powerful emotional framework for investors. But emotional frameworks are not investment strategies. Disciplined capital allocation requires distinguishing between structural drivers and storytelling momentum. And when those distinctions become clear, the case for urgent accumulation becomes far less certain than it first appears. Another major pillar supporting the argument for immediate silver accumulation is the belief that inflation alone guarantees higher silver prices. The reasoning appears straightforward. If currencies lose purchasing power, tangible assets like silver must rise in response. But financial markets rarely behave that simply. Inflation does not automatically translate into silver appreciation. In fact, historical market cycles show that silver's performance during inflationary environments has been inconsistent rather than predictable. In several periods of rising consumer prices, capital flowed more aggressively into energy markets, equities tied to pricing power, or even short-duration fixed-income instruments rather than precious metals. Inflation changes investment behavior. It does not dictate it. Equally important is the role of real interest rates. When real yields rise, even during inflationary environments, precious metals often face downward pressure because investors can earn returns from yield-bearing assets instead of holding non-income-producing metals. This dynamic has repeatedly influenced silver more strongly than inflation itself. Understanding this distinction helps explain why silver does not always behave like a reliable inflation hedge despite its reputation. Another widely accepted assumption is that silver functions as a dependable safe haven asset during periods of geopolitical instability. Supporters of this view point to silver's long history as a store of value and its physical nature as evidence that it protects wealth when uncertainty increases. However, modern market behavior suggests something different. During major global stress events, capital tends to move first into U.S. Treasury bonds, the U.S. dollar, and gold, not silver. Silver often behaves more like an industrial metal than a monetary refuge during early crisis phases because its demand profile is partially tied to economic activity. When growth expectations weaken, industrial metals typically struggle. This dual identity, part monetary asset, part industrial commodity, creates volatility rather than stability. It means silver does not always respond to crises in the way investors expect safe haven assets to respond. Another argument frequently used to support immediate action is the idea that macroeconomic signals are aligning to create a narrow window of opportunity. Rising inflation, currency debasement concerns, geopolitical tensions, and global debt expansion are often presented as a perfect storm that makes delay especially dangerous. But perfect storms rarely arrive without warning. Markets adjust gradually as macro conditions evolve. Large institutional capital does not reposition overnight. Instead, it rotates step by step across asset classes in response to liquidity conditions, policy expectations, and growth outlooks. When investors are told that hesitation itself creates risk, the message often reflects narrative urgency rather than market structure. Urgency encourages action. Structure determines outcomes. Timing arguments are especially persuasive because they appeal to one of the strongest psychological pressures investors face, the fear of missing out. The suggestion that waiting even a short period could dramatically reduce opportunity creates the impression that action must happen immediately rather than strategically. Yet history shows that the best long-term investment decisions are rarely made under time pressure. Markets reward positioning, not reaction. Silver has experienced multiple cycles in which expectations of imminent breakout movements circulated widely before price action confirmed them. Investors who acted based on urgency alone often discovered that the anticipated move took years, not months, to develop. This pattern is not unusual in commodity markets. Another overlooked factor is liquidity preference during uncertain economic transitions. Investors frequently prioritize flexibility when volatility increases. Physical metals, while valuable as diversification tools, are less liquid than financial assets in fast-moving environments. That reality affects allocation decisions more than narratives about scarcity or inevitability. In practice, capital seeks efficiency before conviction. This is why macroeconomic convergence does not automatically translate into immediate price acceleration. Conditions may be improving for silver structurally, but structural improvement does not guarantee short-term price response. Recognizing the difference between long-term potential and short-term inevitability is essential. Investors who understand this distinction avoid confusing opportunity with urgency and strategy with speculation. Supporters of the immediate silver accumulation thesis often conclude with a powerful message. Silver is scarce, historically resilient, and positioned at the center of a coming wealth transfer. According to this perspective, hesitation today risks missing one of the most important financial opportunities of a generation. It is a compelling narrative, but compelling narratives are not the same as investment certainty. Scarcity alone does not determine price acceleration. Many resources are finite. What matters is whether scarcity translates into sustained capital demand at scale. Global investors allocate trillions of dollars based not only on availability, but on liquidity, institutional participation, policy alignment, and macroeconomic visibility. Silver's finite supply is real. But finite supply does not automatically create explosive upside without matching financial demand. Another argument frequently repeated is that silver has survived centuries of economic crises, currency collapses, and political instability while maintaining intrinsic value. Historically, this statement is correct. Silver has preserved purchasing power across long-time horizons and has repeatedly re-emerged as a relevant asset during monetary transitions. However, survival is not the same as leadership. Assets that preserve value are not always the assets that outperform. Investors seeking growth must distinguish between stability and acceleration. Silver's historical resilience supports its role as a diversification tool, but it does not guarantee that silver will lead the next major cycle of wealth expansion. Modern markets reward positioning within dominant capital flows, not simply alignment with historical precedent. Another persuasive element of the bullish narrative is the suggestion that today's environment represents a rare convergence of inflation pressures, industrial demand expansion, monetary uncertainty, and limited mining output. Together, these conditions are often described as a perfect storm capable of triggering rapid price recognition. Yet, perfect storms in financial markets tend to unfold gradually rather than suddenly. Institutional capital typically reallocates across phases. First into liquidity protection assets, then into macro hedges, then into growth-sensitive commodities. Silver often participates later in this sequence rather than leading it. Investors who assume that convergence automatically produces immediate acceleration may be mistaking structural alignment for timing precision. And timing precision is where most narratives fail. Perhaps the most powerful claim supporting immediate action is the expectation of a coming wealth transfer, an argument suggesting that early participants in the silver market will benefit disproportionately once broader recognition arrives. Historically, wealth transfers do occur when markets reprice misunderstood assets, but they rarely occur without confirmation from capital rotation. Major repricing events typically follow measurable shifts in institutional allocation behavior, not simply improvements in retail awareness or media attention. When wealth transfers happen, they are visible first in liquidity flows, currency movements, and policy responses, not headlines. Understanding this sequence changes how disciplined investors respond to opportunity. Silver can absolutely play a meaningful role inside a long-term portfolio strategy. It offers diversification, industrial relevance, and partial protection against monetary instability. These are legitimate strengths. But treating silver as an urgent, all-or-nothing positioning decision risks replacing strategy with conviction, and conviction without confirmation increases risk rather than reducing it. The most effective investors recognize that markets rarely reward those who act fastest. They reward those who act with clarity, patience, and structural awareness. Silver may indeed benefit from long-term macroeconomic changes now underway, but long-term positioning is very different from short-term urgency. Understanding that difference allows investors to participate intelligently rather than react emotionally. In the end, the real advantage does not come from acting quickly, it comes from acting correctly.